I'm Harry Rock, and welcome to another edition of the Westfield Council on Aging Presents. This is a special collaborative effort with Mike Squindo, Executive Director of the Westfield Senior Center, Tina Gorman, COA Special Projects Coordinator, and Pete Coles, producer of WCPC Westfield Cable Channel 15. Our topic today is reverse mortgages, and my guests are Leslie Lambert, Realtor at Park Square Realty, and Millie Potter, who is a reverse mortgage specialist from CMG Home Loans. We're going to be discussing reverse mortgages, which is a topic that you see advertised frequently on television. We're going to cover what it is, how it works, and who is best suited to take advantage of it. It is important to note, however, that it's not for everyone, and this show is not an endorsement of reverse mortgages. You need to carefully and thoroughly research the concept of reverse mortgages and move cautiously before ever deciding to commit yourself to this program. So, Leslie and Millie, welcome to the show. We're thrilled to have you here.
Thank
you know, it's interesting. This is a topic, I see it on television all the time. And it's always, I'm trying to think of, all these famous actors and athletes that are promoting this. And so you make it, and it sounds like this panacea of this, it's free money and all this kind of stuff. There's a lot of misconceptions on it. And I was looking forward to this from the standpoint of educating myself, because I know it is the right choice for some people in the right situation, but also not the right choice for some other people. So what we want to do is make sure that people really understand as they're watching these commercials and they're thinking about this and they're exploring it, we really want to get into in depth exactly what this is. So first, I'm going to say hi to my good friend Leslie. We serve on the Friends of the Westfield
Senior
Center board.
Yep.
And so thank you for coming on with us. Is this a busy time for you right now for the Realty?
Of course, but I always have time for you.
Oh, we like that. We like that. And Millie, a little bit about you. Where's home for you? Where do you operate out of? And how long have you been doing this kind of work?
So home for me is Feeding Hills.
Okay.
I started doing mortgages in 1989. Prior to that, I was in banking and then they kept eliminating jobs because they were relocating. So it was mostly mortgage companies until 2011 when I started with United Bank, and I was at this office here at the main office in Westfield for a while.
Yep.
And most of my career, I focused on Westfield and Chicopee because the places I worked offered VA loans, and those were prime targets. Not that that's all I did, but it was a great, helping veterans get into homes when they thought they couldn't. And I started with this company after the last bank I worked for, which was United, was merging with another lender, and they didn't want the mortgage division we had. So I went back to a mortgage company, and I was with them for 3 years, and I saw the opportunity to go into reverse. So 2 years ago, I started doing reverse mortgages exclusively.
Wow.
Because there's a great need out there.
Okay, so you really know your product.
I know my product.
And Leslie, do you run into this in your line of work with as a realtor?
I do, and the usual question is it still like it was in the 80s, which was not the same as what it is now? And the reason that I wanted to come and talk with you is Millie came and presented to our office a couple of weeks ago, and she opened my eyes. Even as a seasoned professional, I've been a realtor since 1988. So even as a seasoned professional, I still had the wrong idea about reverse mortgages, and they've changed drastically. And like you said, it's not the right thing. There's no right program for every person, right? You're not going to put people in a shoebox, but for certain people, if they don't know that it's not there, if they don't know what they don't know.
Right. Mm-hmm. So Millie, let's jump right into it. What exactly is a reverse mortgage?
So it's just as it's described. It does the opposite of what a regular mortgage does. With a regular mortgage, you're making payments and the balance is going down. With a reverse mortgage, you're not making payments and the balance is increasing with interest charges and mortgage insurance. So,
but you can make a payment, right?
Payments are accepted. They're just not required. So you can, you know, if it's somebody who needs a temporary fix, they don't qualify for a home equity line of credit or a regular mortgage, they can do a reverse, solve their problem. Maybe it's a home repair that's costing more than what they can afford to pay back. But they can make payments and pay it down and possibly pay it off over a longer period of time.
So is it right so what are the conditions by which a person would decide that it's right for them or not right for them?
So first we'll start with age. For
Okay.
the FHA version, the minimum age is 62. But if it's a couple, only one of them has to be 62. The other can
Oh,
be younger.
okay.
And then we have some proprietary programs that go down to age 55. But at 55, you're not going to tap into as much equity as you would at 60 and over. So the older you are, the more available equity there is. And in 2015, they did fix the program. They used to allow a lot more equity to go out at the start, and people ran out of money. Now they limit what can be accessed. So an average person aged, say, in their mid-70s can access about 40% of the equity,
Oh, 40%, okay.
roughly. And some of that depends on what their actual age is, what the value is, and the third component is where's the interest rate.
So when you talk about 40% of equity, so if I have bought a home and I still have a mortgage on it, and I've paid, say, half down, so maybe I've got $50,000 in equity in the house at that point, I can access that $50,000.
No,
No.
that's not how it works.
Okay, so how does it work?
Let's say you bought a house, 10 years ago, you paid 500, or it's worth 500 now, and you still owe 200.
Okay.
40% of the equity is 200,000.
Okay.
But so you'd be able to pay that off as long as you had money for the closing costs, because there are some closing costs involved. If it was less than say it's 180, you could probably get that done, pay off the loan, cover all the closing costs. And you wouldn't have any access to any more of the equity because they expect you to live another 10, 20 years, and the interest charges will increase that balance so that it could. We try to make it so, or it's designed so that the balance doesn't exceed the value by the time you reach your life expectancy, which is just over 80 years old for men and women. So
Oh, I've still got some time.
you still got some time.
Let's hope so. Let's hope we all do.
Oh my gosh, I know it. So you can take a reverse mortgage if you still owe on a mortgage.
You can, to
Okay.
pay off that mortgage.
Okay.
There can be no other liens on the property when you close with the reverse.
Okay. But if the house is fully paid off, you can only access. So if the house is completely paid off, it's worth $400,000. You can only access 40% of the $400,000 value.
Right.
Okay.
Which is a big change from how it used to be. And this is why I really wanted to talk about this, is because before the changes happened, people were getting into trouble and had a bad reputation.
So they were taking full access of the entire
And-
value of the home?
And as I understand it, Millie can correct me, but as I understand it previously, the borrowers were also doing a lot of their own financials, which is not a great idea in most cases with a loan. You want a professional at hand. So the way that it was presented, that Millie presented it, was like a game changer.
Right.
It's way safer, in my opinion.
Millie, do all banks offer reverse mortgages?
Very few banks do. Mostly mortgage companies
Oh,
do.
it's mortgage
There are
companies.
a few around the country that offer it, but I think there may be maybe one or two here in Massachusetts, in the eastern part of the state. But for the most part, it's the big lenders. They don't. It's kind of a niche product, and a lot of the companies like to stay clean on just offering FHA, VA, and conventional without too many fancy things.
Okay.
It does have an FHA component, though.
It is they're FHA insured. The regular home equity conversion mortgage is what
Okay.
they're called. The proprietary programs allow younger age and also allow a greater value. So FHA's limit right now on a value where you could access that full 40%, let's say, is $1,149,875. If it appraises for more than that, you're still only going to get 40% of that $1,149,000. If it appraises for $2 million, you use a proprietary program, you'll have access to more of the equity.
So are they taking, when we talk about equity, are we talking about the amount of money that you have physically paid into the house, or is it the value of the home at that point in time based on the market? So right now the market's going crazy. Values have jumped and doubled, and so my equity could be double what it was 3 years
Exactly.
ago.
Exactly. If you paid $500 for it 3 years ago, Leslie, probably worth $6 now.
Yeah, absolutely. And this is where the hand-to-hand with a lender and a realtor come in, because we're going to be able, as a realtor, I'm going to be able to go in and give an updated evaluation of what your home equity likely looks like at this time and place, in advance of going through the whole banking thing, which has appraisals and everything involved. But at least people can learn ahead of time what their home is worth today, and it's likely more.
It is likely more, you're right. So you're working with a realtor.
can
So
be.
when somebody comes and says, I would like to have a reverse mortgage on my home, how do you determine the value? Are you determining the value, or do you go to an outside realtor to get an outside
So-
perspective on what that home is really worth?
So sometimes I reach out to a realtor if it's a unique property, because sometimes I can't find anything online that tells me anything close to what it could be.
Okay.
If it's on the internet, and I look at 4 different models. I won't name any names, but there's 4 different ones that typically will show a value, and I either use an average of those 4 numbers, or I use the middle point, high or low, and take the middle. And I advise the client, until the appraiser sees it, this is only a hypothetical number. And that's true even if a realtor gives me a number.
Correct.
The problem, when an appraiser goes to a property when it's not for a purchase, they don't have a roadmap. They don't have a number in the purchase agreement to say what it's selling for. So they suppose on whatever parameters they determine are logical, which don't always seem logical, they determine a value that way. So they may find a home right down the street that's sold, which is great, but the closest one may be 3 miles away, and is that really a valid, based on neighborhoods and so forth, and custom builds and all of that, is that a valid number? So sometimes we run into issues with the appraisals.
So you always work with an appraiser.
We have to,
So that's what I was getting at. So
in the end,
so
but we
you
start
will-
without.
You start, either you're doing your own assessment based on what comparable selling prices have been, or you're talking
To
to
a
someone
realtor.
like the lovely lady over
Right.
here, Leslie, who would give you a number of
Yep.
what she thinks based on her experience and what's going on.
And what's going on, yep.
And then you have to back that up with an appraiser.
An
So,
appraisal.
okay, so there's 2 steps to this whole thing to determine
are.
really what the value is.
And to throw in another monkey wrench into the process, FHA can say, if the appraisal comes in at X amount, they can say, we want a second one because we're not sure we like that, that it's
Okay.
valid. So it can require a second appraisal, which will just delay things. But,
Well, and for people that might not understand, FHA is a government-backed loan. Millie would be better to describe that,
Yep.
but I know not everybody knows what it's the Federal Housing Authority. And so, Millie, do you want to tell what
Yep.
that means?
So it means that the property, if we're using that program, the property has to meet standard FHA guidelines. So some of the issues we run into, there's a set of stairs and there's no handrail. That's a safety issue, so that has to be remedied.
Oh,
And I
okay.
usually ask the client before we go to the appraisal stage, tell me about your house. Is there any peeling and chipping paint? Because if it was built before 78, there could be lead paint.
Oh,
And FHA doesn't like that much either. The roof, maybe the roof needs repair. Maybe that's part of the reason we're doing this. We can set aside the money to pay for the roof repair, and then it's okay. It'll just require an inspection after the fact. So really depends, the condition of the house. I want to know, if it's just clutter and so forth, or is there more to it that could be an issue?
Interesting. And does there have to be a certain amount of equity available in the home in order to qualify? Is there a set number that you work with, or?
It's based on age, interest rate, and value. And what they have for liens, if there's liens, or what it is they need for repairs, or whatever they're using the money
Okay,
for.
so there's a number of factors that you're
That we
looking
look
at.
at before we move forward. And there's other steps that have to be taken before we can move forward. There's mandatory counseling from an independent agency
Counseling to the
to the homeowner that is an independent review of, so I prepare what's called a proposal. In that proposal are all the numbers, all the facts, a graph to show how the balance can grow so they understand it. But there's also a list of 10 local licensed counseling agencies, independent of any lenders. I can't refer them to anybody. And they have to do that counseling. It's about an hour and a half long.
They're required to
They
go
are
for?
required. I need a certificate.
Is that right?
I need a certificate signed, and
I
in
did not-
Massachusetts, just recently, they went back to, during COVID, they could do it over the phone or on video. They just went back to mandatory in-face counseling, which means they have to go to the counseling agency to do it, or the counseling agent has to come
And
to their
what are they being counseled on?
on the logistics. So they don't want a salesperson explaining the program because I may gloss over certain things. That's not that I would, but we allow the experts who do the counseling to do their thing, explain it, make sure they understand it before they can move forward. So they actually sign the counseling certificate, and so does the counselor, basically saying, I've done this, and I still want to go forward.
And I think that's just transparency.
Absolutely.
So that they are.
No taking advantage
Yes.
of seniors.
So the seniors are fully aware of what they're walking into. They've made their financial decision, knowing everything that's on the plate.
Right.
And I personally, I think that's wonderful.
Yep.
How popular are these right now? Are they growing in popularity? Are they about the same? How do people view these?
Well, there's still a lot of people that hate them, that will talk against them no matter, every chance they get.
Okay.
But they are becoming more commonplace. I won't say there's a rush, but it's starting to have more of an advantageous view by seniors who, the inflation that has been going on over the last 3 years, that's making them question, can I remain in my home? Can I still afford this? Maybe it's a health issue that makes them take a step back and say, what now? I need these expensive medicines. Can I afford that? They may have been doing just fine, and all of a sudden something happens, and maybe one spouse passes and the remaining spouse is, can I still stay? Or should I buy something that's more manageable? And do I have enough equity to do that, or do I need a reverse to help me do that? Because it can be used for both purchase as well as refinance.
What?
Yeah, and I want to actually put a pin on that. I think that's the thing that people don't know is you can use it to buy a secondary home,
A different home.
a different.
It has to be an owner-occupied property.
Yes, thank you.
They can buy a second home with assets from their primary residence, or use partial, use a reverse to get some money out to put down on a second home. Maybe they're in their 60s and they want that second home to retire in eventually. Do that now, buy that second home, you have the payment on that, no payment on the one you're living in. And when you're ready to retire, you sell this one, pay that off.
If a person wanted to just take a loan, like a home equity loan, could they do that? And would it be the same thing, or how is that different?
So a home equity loan requires payments, only interest payments, but you have to make payments.
Okay.
And they sunset after 10 or 20 years, which means you have to do it again every 10 to 20 years, depending on who you went through and what their terms are. And maybe 10 years later, they no longer qualify. So the reverse can pay it off for them. and eliminate the payments.
So essentially with the reverse mortgage, so if you've paid off your home, you owe nothing to anyone.
Yep.
What are the conditions where I would say I want to do a reverse mortgage?
So I'll give you an example of a woman who had paid off her home. She had been working, even though she was just over 70, she'd been working part-time to supplement her Social Security income. She had a minor stroke and couldn't work anymore. She lost about $750 a month in income and wanted to replace that. So we looked at it. She could receive $750 a month for the next 10 years. If she wanted to receive money for the rest of her life, we could have only given her about $560 a month. She really wanted the $750, and she felt after 10 years, if she was still with us, she would probably sell the house and move to where her sister lives. So it's, it's a solution for her situation. It's not what's right for everybody, though. Some people have invested assets, and when the stock market's down, those assets, if you're drawing from them, you're losing money. You could use a reverse to draw from when the stock market's messed up. And then go back to drawing from stop drawing from the house and draw from the stock market again when it recovers. So you're preserving your invested assets while using some of the equity in your home.
But you can run out of that 40%. So let's just take a number. Let's say my 40% is $50,000. How can I receive those payments?
So you can receive a monthly amount, either a set amount or what they calculate as what you could receive for the rest of your life, even if you live to be 100.
My rest of my life is considered 80?
Nope. The rest of your life, they're calculating it based on 80, but you could live to be 100 and you're still going to receive that amount. So if you were somebody who had a good amount of equity and you only needed what you can qualify to get, you'll get that money regardless of what the balance is. If you require more than what you can get monthly, then it will last for the number of years based on your age that it can last. There's all the calculations are done within the program. And, maybe in her case it was $750 was the number. Somebody else maybe $1,000, and maybe that's only for 7 years.
But when the number of payments have come in and it equals 50 and I'm now beyond, am I still receiving a payment, or is
You're
it?
still receiving a payment if you're doing the for life version, yes.
But that goes against the total value of the house at that point.
Right. It'll.
Okay. So it's not free money.
It's still going to be.
It's going against the value of the house.
Correct.
So you're now paying against the other 60% of the equity that's remaining
They're
in the home.
drawing from that equity.
Okay,
Correct.
so it's not, and that's what's important to hear. This
It
is not
not
free
free
money,
money.
people.
It's not free money.
It's not free
Not
money.
ever.
So you're drawing, when we hear that you're getting money for the rest of your life, it's just drawing against the equity, the remaining equity in your home.
Correct.
Okay, that's
Even if
important.
the home's value and we've had instances where values dropped dramatically, and people were upside down. If they pass at that point, and I know that's one of the questions, what happens? What if I owe more than what it's worth? So the heirs or the owner, if they're deciding to sell while they're still alive, only have to pay back 95% of what the house is worth at the time they sell. So we get an appraisal, and 95% is all that has to be paid back.
So is there a risk on the mortgage company that you could end up not receiving back as much as you've paid out?
So the FHA version comes along with mortgage insurance that the borrower is paying, and that insurance fund is what makes up the difference. So the lender doesn't get burdened with it, the owner doesn't get, or their heirs don't get burdened with it. It goes to the FHA insurance fund.
Okay, so you are receiving your full
We're
share,
getting- right.
what's owed to you.
Right.
So you're not losing out or anything.
No.
There's no risk in it for you.
Nope.
Okay.
It's pretty
And the
good.
owner or their heirs still own the property.
Correct.
It's their home, and they can sell it as,
The heirs could buy it out
yeah.
for 95% of the value
At the time.
at the time it's being sold.
So if the market has crashed they're paying 95% of a much reduced number.
Correct.
Or if it's escalating like it is
They
right
could still
now.
get some equity. You know, there still could be some equity left.
Interesting. Are reverse mortgages denied?
They can be. So some of the reasons could be a low appraisal. You know, maybe they still have a mortgage of 100,000 and, you know, they're 62 and it can only access 30+% of the value. That's not enough to pay that off. Or it could be a credit issue. Now, there's no credit score requirements. There's also no debt ratio requirements. However,
Which is unique.
yes, they do look at their payment history for the last 2 years. If they've had no late payments on anything, including taxes, insurance, and all of that, then credit is fine. Don't care what the credit score is. If they've had late payments, but it was caused by a medical condition, a loss of a spouse, you know, where they, you know, sudden loss of income, unexpected, in that case, with documentation, we can waive the requirement to hold back taxes and insurance. So you can still close on it if you have enough equity for us to set aside the cost of taxes and insurance through your life expectancy. So that could be anywhere from 6 to however many years. But depends what those taxes and insurance cost, because we're projecting forward what that's going to cost, how much of the equity we have to set aside. If they don't have enough equity to do that set aside, and they had those issues and they weren't caused by something unusual, then we're not going to be able to do that loan. Generally, the loan doesn't necessarily get denied by an underwriter. It all is part of the conversation we start up front. What does this look like? What does that look like? You know, if they tell me, well, you know, I lost my job and I couldn't find another one and I was late on my mortgage 3 times, that's documentable. But I was lazy and I didn't pay my bills. Or, you know, it doesn't make sense that they should have been late on something. Maybe they took vacation and skipped the mortgage payment 1 month. People make bad decisions sometimes. That's going to be tougher to explain. Doesn't mean they can't do the loan, but we have to do that set aside. And there has to be enough equity to do that.
Okay, that makes sense.
But this is a product that's unique in especially what she was just discussing with the credit
No credit scores.
requirements and the debt to income ratio. You're not going to get another loan that way anywhere
Right.
outside of a reverse mortgage. So again, for the right people, if they're in a situation where this could solve a problem, those are very unique opportunities.
Yes.
You know.
But it's a way for people, you know, it's basically they're tapping into their savings plan, which is equity,
Yep.
and using that.
Yep.
And again, so they go in, they get their loan approved. Now they're receiving, you said you can receive it monthly
It could be a line of credit to draw from when needed.
or a line of credit. So
Yeah.
it's just sitting there.
Yes.
You don't have to access
You
it.
don't have to touch, I mean, most people that want it for a line of credit, they're taking very little up front. Maybe they want enough to pay off a car loan or something, you know,
Okay.
just to get rid of another bill. And it's just going to be there. So when they need the new roof or the new furnace or whatever home repair is required, they can access it without applying for a new loan, you know, going through the process.
Dipping into their retirement,
Right. They don't have
wherever
to
else.
liquidate assets. Right.
And the interest rate for a mortgage company doing this, is that higher than a traditional mortgage payment, or is it equal, or how
So
does-
regular mortgage interest rates are very similar to what the reverse is. The reverse offers some programs that a regular person may not look at. So there's a fixed rate that is usually a little bit higher than what the fixed rates are in a regular mortgage. There are adjustable rates, 5-year, 10-year, 5% cap, 10% cap, and a 1-year adjustable. So it adjusts monthly if you take either the 5 or 10% cap. So you have a start rate of whatever, let's say it's 7% right now, which is about close to where it is. every month it's looked at. It cannot go up more than 5% in its lifetime. So, and it also can't go down more than 5% in its lifetime. If it's the 10%, same thing. So using a 5% cap gives you greater access to the equity because what's factored in is the downs as well as the ups. So they do an average of what the rate could be. And right now, the average rate, if it starts at 7, the average rate is that they're determining is going to be around 6.25. Where if we do a fixed rate at 7.25%, it's flat. There's no adjustment. It's going to be that as the calculation. So a lot of the loans we do are adjustable rates, especially with the rates where they are now, because there's a pretty good chance they're going to go down more
Right.
so than up.
Yeah, interesting. And they can receive their payment in full if they want?
They can take a lump sum, well, with a caveat. In the first year, they don't allow them to take all of the equity
Oh, okay,
unless it's being used to pay off a lien on the house. Then they
Okay.
could take all their equity.
okay.
If they're doing a line of credit and wanted a lump sum to go buy something else, after the first year anniversary, they have access to all the equity. So maybe what they do is take the chunk now, do a mortgage on the property for a year, and then take the rest and pay it off.
So let's go through the pros and cons, simplify this thing for all of our listeners out there, because this is a lot of information for you to take in and try to synthesize. And I will admit, even I'm like, wow, I got to think about all this. So let's talk about the pros.
Okay.
Pros of doing this.
So the pros could be to rebalance the budget. You know, things that just aren't working right now and they need more income or they need to get rid of that mortgage so they have an extra X amount. You know, it's really about living the way you want to live and not being burdened and worried about where am I going to have money to pay for groceries next week because I had to pay this and that. And so that's one of the pros. Another pro could be they want to retire but think they have to keep working, you know, well into their 70s. Not necessarily. And, you know, maybe they're starting to draw. So anybody who has long-term care insurance, the older you get, the more expensive it gets. And if you live a long time, those premiums can get pretty hefty. Maybe you just use it to pay those premiums. You know, it could be as simple as that. It's just giving you that comfort so that you know when you need to go into a facility, you make the choice because you have that long-term care insurance.
Right.
And it
Safety net.
It could be. And it could also pay for in-home care. Maybe you have to have somebody come in once a week or every now and then, and that extra cost, you know, it could be to draw just for that. A lot of different reasons and advantages that they can use it for.
And the opposite side
The
of the
opposite
spectrum, the
side.
cons.
The cons. So, of course, you could use up all the money. And then, you know, if you're in a situation where we have to pay your taxes and insurance for you, or you requested that we do that, that only goes to your life expectancy. If you live beyond your life expectancy, now you have to pay that yourself. Maybe that's the
And
time
the
you sell.
life expectancy is 80.
It's a little over 80. I think it's
Okay.
81 and 83. 81
Okay.
for men, 83 for women, the
Okay.
last time I checked.
Okay.
That may have changed with the pandemic because
Yep.
more people in those age groups passed younger.
Right.
So. But it's still going to be over 80.
Okay.
And, you know, you can run out of money. You have to maintain the home. You know, if you don't have the wherewithal to fix the roof when the roof starts leaking, now you have to sell or have family members help you out. And I present this sometimes, you know, the children usually have the biggest objections to doing a reverse.
Oh, interesting.
And, you know, I explained it to them, well, right now, this is the situation. Your parent needs X, you know, whether it's money for a new roof, whatever. Or I had a client who had their condo fees double because of some deferred maintenance. Well, that doubling put a big strain on their budget. And were the children going to make up that difference so they could stay where they were? Or should they do a reverse? So if the children are objecting to losing the equity that they may inherit, fine, then you help your parents pay these bills that they're worried about paying. How's that?
And I think that's a very real consideration. So because the
Absolutely.
children are thinking that, well, the house and that was one of the things I was thinking about last night when I was prepping for this, is the fact that you make up your will and you say, my home, I'm going to give my home to my children, or they can sell the home and split up the
Yep.
money however they want. But if there's nothing left in it, if it's all that, I can see where for the children they're saying it's really not their right to do that because the home is owned by the parent. But I could see where the children would say, wait a minute, you're eating up all the equity.
Right.
We're going to inherit. So basically they're inheriting a house that they now owe full value on.
Maybe, or
Potentially,
maybe-
or 40%.
Right.
But they're going to have to pay money.
To get,
Well, the
Well,
estate is
the
going
estate,
to.
right, it'll be sold if they don't want to keep it. It'll be sold and they'll get the difference instead of the full amount.
Okay, so if
It's
they
not
could
out of their pocket.
Oh, I see what you're saying. You're right. So if they sell it, they would get, say, 60% of the value because the
Right.
reverse mortgage is taking 40%. And if they want to keep it,
Mm-hmm.
they now have to basically take a loan out for the 40% that has been taken out. They're now paying back the mortgage company,
Correct.
correct?
Correct.
For that 40%.
And the sooner they do that, the better, because interest charges are added. So one important thing is for seniors to either have a will or to put the house in a life estate or a family trust,
Absolutely.
because otherwise it goes through probate. And while it's going through probate, which can take 4+ months,
Interest is accruing.
interest is accruing. So the sooner they can get it on the market and sold, they can't close it till it's out of probate if it's in probate. You know, the more interest they have to pay back.
Oh, that's interesting.
Yeah, there's a lot of levels, layers.
Yes.
Right. And then are they paying, so when they take out a reverse mortgage, they're receiving, let's say they take a payment out every month. Is that considered taxable income? Do they have to pay
No,
income
because
taxes
it's a
on
loan.
that?
It's a loan.
Oh, it's a loan.
It's a
So
loan.
there's no
So there's-
taxes.
Correct,
Because it's a loan.
correct.
So it's not
Untaxable
reportable, it's not reportable income.
Right.
All right,
But
that's important.
full disclosure, I'm not a tax accountant.
All
You
right.
should check with your tax
And
accountant.
neither am I.
Right, yeah, right.
But it is a loan,
Right.
and loans are not taxed in.
Right. And so you take out the reverse mortgage, but you still live in the house and you still own the house. It's just a loan. It's a loan that's against 40% of the value
Right,
of your
it's a
home.
lien on the property.
A lien on the property.
And they
Okay.
don't have to access the money if they don't want to or need to.
Okay.
But it provides maybe a financial cushion for some people who might fall into the categories that Millie discussed. I mean, for me, in my business, what I run into the most is death of a spouse,
Yep.
health issues, loss of a job, and then they're stuck with very few options. And maybe they really don't want to have to move or don't have somewhere they feel comfortable moving to. This might be a resolution for them. It, not going to be for everyone, of course, but it could solve a problem that I think a lot of people don't know that this is available to them right now as an option to
Right.
at least explore and discuss and learn about.
Okay.
And one thing with the seniors that is a challenge, they realize the house they're in probably is not where they need to be for the rest of their lives. They're not ready for a nursing home or assisted living, but they're concerned. If I put this on the market, there's nothing out there to buy. How am I going to buy?
Right.
Well, that 40% that we give them of the home they own can be used as a down payment to supplement what they can pay cash for. So they actually could buy something that fits their needs, all one level, laundry on first floor and all of that, proper square footage, and they, from the proceeds they receive for the sale with the reverse, they can preserve some of their assets or not need to bring any additional money to closing. So it can give them a better home that's fairly new. It may be a 55 and over community, as long as it meets FHA guidelines. You know, get into a condo situation. that's
Again,
better
it's
for them.
opportunities. It's opportunities to make that transition because, I mean, it's a big topic, really.
Yeah, it really
It
is.
really is a big topic, how to transition from your family home, which probably housed, for most people, some kids and
Right.
might be multi-leveled, and or the laundry's in the basement and your knees are not what they used to be. And these are the things that come up all the time. And so, you know, not only is it good for people who want to stay and age in place,
Yeah.
which if that's their goal, that's wonderful. But if they would like to make a move and they just don't currently have the financials in place to make it happen, this could help make that goal
Yeah.
too.
Yeah. No,
In
it's-
aging in place, it can be used for doing some of those accommodations. Maybe putting in the walk-in shower or lighting along the
Oh, I
floor.
see.
Lighting
Okay.
along the floor in the hallway.
So you could take that money and,
You can
and
take
reinvest
that
in
money
your
and
own home
reinvest it in the home and make
to
it
make it
more.
ready for your
Right, bring the
that
laundry to the
becomes
first
your
floor.
long-term care
Exactly.
home. That's interesting. Okay, and again, just to reiterate and reinforce, because there's a lot of information here. To determine the size of the loan that you get, you're going to be when they come in and talk to a reverse mortgage agent like yourself, you're going to do a potential assessment
A
of what you
proposal.
think it's worth,
Correct.
or you're then maybe bringing in a real estate
Exactly.
agent
To get
to
closer.
give you a number, what you think, but eventually it's going to go to an appraiser
Correct.
to get the exact number.
Correct.
So that's where the value
And that
comes
can
in.
change the numbers. And
Okay.
if the appraisal comes in, it comes in higher, it gives them more advantage. If it comes in lower, we may have to regroup and figure things out
Right. And then it's 40% of that number.
of what the appraised value is.
Okay, see, we're getting there. Now we're starting to understand
And
this thing.
appraisers are always a third party,
Yeah.
completely separate from the transaction.
Okay.
Correct.
Millie cannot choose what appraiser gets assigned, nor can a realtor if I'm involved. It's a blind assignment,
Yeah.
and I think that's important for people
Right,
to
so it's
understand.
truly independent,
It's
outside independent.
completely third party, neutral assessment.
That's an important,
Yes.
yeah, that's absolutely. And then again, the loan gets paid back at the time
It's sold,
that the house is sold.
right.
Okay,
And it needs to be, so let's say a spouse passes or the final person passes and it's determined it has to be sold. Generally, they give them 3 to 6 months to take care of that. They can request an extension if it's an off market where things aren't selling, which is not what we have right now. They could go up to a year, but interest charges are added, so the sooner the better.
and if the house has been willed to the children
Yep,
through probate, they receive ownership of the house, and then it's their responsibility to pay back that 40%
That's correct.
and whatever interest
ASAP.
charges. And to your point, do that as quickly as you can.
because the
Right.
balance is just going up.
Okay, but essentially the children or whoever it's being left to, they now own that
That's
debt.
correct.
So they have the responsibility of paying back the debt. Okay, this is starting to make sense.
Yeah,
All
the
right.
property does not change ownership on any
Right.
level. It's always either the owner or their heirs
Right.
that own the property, with or without debt.
And then again, just to reiterate, if a person decides to go to reverse mortgage, they are required to satisfy the required to satisfy the reverse mortgage by making sure that they're paying the property taxes, paying the insurance, and then maintaining the home.
And homeowners association fees that
And
they
any
apply.
HOA.
If it's a condo fee,
Yeah.
Yep.
and remain in the home as their primary residence.
And it has to
Some-
be their primary residence.
Some
Okay.
people have 2 homes, and they use the one in the state that has no state income taxes as their primary,
Right.
but the value is in the one that's in the state that has income taxes, and that
Right.
can be an issue.
Okay. You know, when I was doing my prep work last night, I came across a term, and I don't know if it applies here, a non-recourse loan. Is
So-
that part of this?
Yes, reverse mortgages are non-recourse. What that means is what I explained before. They do not have to pay back the full balance if the house is not worth more than what that balance is. That's what non-recourse means.
So if the house value drops,
Or they have it for a very long time. If they live to be 100, there's a good chance the balance could exceed what the value is at that time.
and they don't have to pay back that difference.
95% of what it
95%.
appraises for at that time.
Interesting. Okay. If a person decides that this is the right program for them, so they've listened to this and they said, wow, I really like what Leslie and Millie have to say. This is something I really want to look into. What's their next step?
They can call me. They can call Leslie, and start.
And there's other companies out there as well
There
that
are.
do this.
But hey, we're the best.
We like us better, clearly.
Right.
No,
But there are other options
There
out.
are.
But there are.
There
So
are.
the-
And
so-
they could do
so
a
they
search
can
on the internet.
technically shop around if they so
could-
choose.
They could call Tom Selleck.
Right. Tom Selleck. Right. Exactly.
Oh, is that the one on TV? Oh, okay.
Right.
I'm not Tom Selleck.
No, you're way cuter than him.
Right. But they call you
They
and just
call
say,
me, and there's no pressure. It's all information. I ask a lot of questions, so I get it square in my head, so I can give them the right information. It's basically, do you have a balance now?
okay.
The basics, and what do they think their house is worth? Have you talked to a realtor recently? Did they give you an idea?
Right.
And if not, then I do my search, and if I can't find anything, I call Leslie.
Right.
Well, and from my side of the page, a lot of the time, not moving is the answer that's the right answer for these people. And that's okay too. Like, yes, I make my money helping people move. But especially with my senior clients, if I'm sitting with them and I can just feel from their heart and their emotion that they don't want to go, except they feel like they just have to, then maybe this is an option where they don't have to go. And am I losing out on a transaction? Yep. But I'd rather make people happy at home and do
So
the
this
good
is
karma
where
work.
their taxes have gotten too high, or their living expenses have gotten too
Yeah,
high
right.
beyond
Medical
what they're-
expenses.
Right. But
And-
so they
and
can,
medicines.
Okay.
Those things can really impact.
so they
yeah.
could take a reverse mortgage to help pay those expenses. It allows them to stay in their home without having to sell
Yeah.
their home and find something
It could,
else.
yeah.
Right.
And, I'm happy to sit with people and talk about this. And if we sit and that's what they tell me, I'm calling you here because we think we have to move, but we really don't want to, I'm going to be the first one to say, explore this option.
Right.
And at least look into it. It might not feel comfortable. It might not be the right choice. I don't know. But here it is.
Right.
And, it can also help them to make a transition if they do need to move, as Millie said. And then we can help that two-step process also. So it just, I think it's just not the product of the 80s that everybody remembers with a bad taste in their mouth. It's a much more diverse and helpful product now for the right person.
One of the reasons I involve the children whenever I can is so that if they decide to do it, they know that somebody like Leslie referred them to me to do this rather than something else, so that when the house has to be sold, they'll reach out to Leslie because she was their champion to get them into the right situation.
Yeah, that's interesting.
We're a team.
Right. No, that's absolutely. There's scams out there.
Oh, there can be.
Oh, yeah.
So what are the scams that people have to be aware of?
Well, you're not going to get a cold call from somebody doing a reverse mortgage. That's against the rules. There's a lot of things that protect the seniors from
Okay.
people harassing them, people saying, you really need to do this. If somebody comes to me and they ask questions, I'll check back with them a month or so later if I haven't heard from them. But I'm doing so in case they lost my number. It's not, hey, you really need to do this. That's not the case. It's, how's things going? Have you had any changes? What are your thoughts? Did you talk to family? Do I need to talk to family? That kind of stuff.
Also, I think going to somebody local where you can put your face to face, is a big difference than just shooting something online,
Right.
some online application. You don't
Right.
know where it's going.
Right.
Those people don't know you. They don't care about you. You're another piece of paper in their email inbox. Somebody like Millie, who's lived here, worked here for over 30 years, she's going to be held accountable because people like myself are going to say, hey, Millie, what's going on? Like,
Right.
and so having this relationship where you've got local teamwork between all of your, and this goes a realtor, a lender, an attorney. There's all kinds of layers that that we can introduce people to that are trusted advisors. And I think that's a huge key, is to
Right.
use somebody local that has a reputation of doing the right thing.
And I'm guessing that there are seminars that come up periodically that people can attend to learn
Well,
more
we would
about
like to
this?
hold one soon, actually.
Yeah.
We're looking to do that.
We'd like to do kind of a senior service fair so that all of the different components of situations where seniors need help with, whether it's home health care or assisted living knowledge. It could be somebody who, nursing, like Visiting Angels are one of those that go in and do
Estate planning.
estate planning attorneys,
Yeah.
reverse mortgage, all of those services that seniors may need to use or want more information on, into a day where we could host it and have, 50 different vendors, whatever it is.
Oh, wow.
And
We don't have it booked yet, but
No.
we're available.
Yeah, right.
and looking at different senior centers, because they all have the, generally the cafeteria, and, we provide, food and
Right.
a little bit of relaxation and fun.
Like a lunch and learn kind of
Yeah.
thing,
Right. Interesting. But there are other companies that do seminars, and
Yes.
so that the information is readily available out
I
there.
generally see more financial planners doing seminars than I do reverse, because, one, they have a client base. We would be reaching out to John Q. Public, and how do
Right.
you attract them? So you don't want
Right.
to have an event planned and nobody show up.
Right.
It's not fun.
Yeah, that's interesting. Well, there is a lot to this topic, and the thing that I would say to all of our viewers out there is really educate yourself. You've heard a lot of information here. I'd recommend that you watch this program again to kind of take it all in, because it does get a little bit confusing, and you need to hear some of these concepts time and time again. And I would also encourage you to go online, read about it, and if you see other seminars, just to get another perspective other than what you've just heard here, to make sure that you feel that what you're hearing here is fairly presented, you need to go and listen to others talk about this thing before you make that decision. And what we've heard here is that it is right for some people, depending on the situation you're in, but it may not be the right thing for you as well, depending on what your situation is. But it is essentially a loan, and regardless of what Tom Selleck says, and he makes it sound like, oh, it's free money. Oh, you've got this free money coming in. It's not. It's a loan. It's against 40% of the equity of your home. So it is a loan. It's going to have to be paid back at the time that your home is sold, or left at the time of your passing to your heirs. So that is a debt that's going to have to be made up. So you just have to be aware of exactly what that is. But again, depending on your situation, you may be in an opportunity to really take advantage of it and allow you to stay in your home when you thought that you might be having to be forced out because you don't have the money to offset your expenses. So definitely do your research. You want to really look into this carefully before you make any decisions at all. So I want to ask the two of you, is there anything that we haven't, as we wrap up here, anything that we haven't talked about that you think is pertinent or you think we've really covered? You've done a great job getting into a complex topic, and I've learned a lot myself.
Good.
So I just have one correction.
Okay.
It's not 40%. It depends on your age, whether it's 30%, 40%.
Oh, okay. I kept hearing
So-
40%. So
Right. A percent of the
it's a
home's
percent.
value.
Okay, so a percent of the home value based on.
Age, interest rate, and the value.
Okay, so it's not a guaranteed 40%. So that's a number. So some amount of money is available to you, and that will be determined at the time you meet with your agent, your
vendor,
realtor,
yep.
and your assessor.
Yeah,
Because
absolutely.
it's a complex topic process as to how we get to that number and try to figure that out. And I just want to reiterate that, again, reverse mortgages aren't for everyone. They may be right, but they may not be right. But you need to be careful about your decision making and thoroughly research the concept, and recognize also that we are not endorsing this concept here. We are simply bringing information to you for your own education and your own decision making. So to Leslie Lambert, my good friend, and to Millie Potter, I've enjoyed meeting you today, and I've learned a lot from you. I want to thank the two of you for coming in and discussing this truly complex topic. There's a lot to it, and I really encourage our viewers, again, to make sure that you get out and research everything you can. But definitely watch this a couple of times, because there's a lot of information floating here, and
Yeah.
it takes a while to sometimes get it all
And thank you for having
taken
us.
through.
Yes, thank you.
Oh, absolutely. I want to say special thanks to Pete Coles, our WCPC Westville Cable Channel 15 manager and producer, for his help and support to make this show possible. And on behalf of Pete Coles, Mike Squindo, and Tina Gorman, I am Harry Rock. This has been another edition of the Westville Council on Aging Presents. Thanks so much for tuning in. We'll see you at the next show. Thanks.